Welcome to the Pro Ticker Deep Dive.
It's great to be here. Fantastic to be back with you.
I have to say, looking at the calendar, it's hard to believe we are already this deep into the first quarter of 2026.
I know. The years just seem to be flying by, especially in the financial world.
They really are. I mean, it feels like it was just yesterday we were all debating whether the recession was, definitely coming or if the soft landing was a myth.
Oh, that debate. It feels like a lifetime ago.
It does. And
Yeah.
now here we are. We're sitting in February 2026, and the landscape looks entirely different.
It really does. That kind of constant anxiety of the last few years it's shifted into something else entirely. It's this strange mix of caution and real opportunity.
Exactly. And that's really the perfect backdrop for what we're talking about today. We're going to be taking a very comprehensive look at a name that, everyone knows, a name that is probably in your wallet or on your phone right now.
For sure.
We're talking about the Charles Schwab Corporation.
A true titan of the industry. No other way to put it.
Absolutely. But here's the thing, and this is really why we wanted to do this deep dive today. I think a lot of people, when they hear Schwab, they have this very specific, maybe even an outdated image in their heads.
Right. I think of the discount broker.
The discount broker from the 90s? Exactly. They think of, $4.95 trades, which aren't even a thing anymore. Or maybe they think of that friendly Chuck commercial.
Yeah, the old ads.
But the Schwab we are looking at today, right now in early 2026, is a different beast entirely. We are talking about a company with roughly $12 trillion in client assets.
That number is just staggering. 12 trillion. It's trillion with a capital T. It's
Yeah.
one of those figures that is almost impossible to properly visualize.
It is. It really is. And the story we are unpacking today is really about a massive transition. 2025 was billed as a transition year for Schwab, but when you look at the data, the earnings, the strategic moves they've made, it looks a lot less like a transition and a lot more like a total resurgence.
A restoration, even.
A restoration. That's a great word for it. We are seeing a legacy giant that is aggressively, and I mean aggressively, reinventing itself.
Yeah, they aren't just sitting back on their laurels and collecting fees. Not at all. They're making moves that suggest they want to dominate the next decade, not just survive it.
Exactly right. They're buying up companies to get into private equity, which we are absolutely going to get into in detail.
Huge move.
They are finally entering the crypto space in a real way. They're deploying AI across the board. And they are doing all of this while navigating a macroeconomic environment that is, well, let's call it complicated.
Complicated is a good word for it.
We are looking at a stagflation-light scenario here in 2026.
Which is a term we will definitely have to unpack later because it has huge implications for anyone holding bank stocks or, just trying to manage their own portfolio.
For sure. So our mission for this deep dive is to pull back that curtain. We want to understand how this massive ship is turning, how it's navigating these choppy economic waters, and specifically what this move into private markets means for the average investor. Because if Schwab is doing it, it usually means the landscape is shifting for everyone.
That's the key right there. Schwab is often a bellwether for the retail investor.
Yeah.
When they move, the market tends to follow.
So let's unpack this. I want to start with the comeback story, because if we rewind the clock just 12 or say 18 months back to late 2023 or 2024, there was a lot of noise around Schwab.
A lot of negative noise.
A ton of it. There were concerns about their balance sheet, real concerns about their liquidity, and just this general anxiety about whether the traditional brokerage model was, broken.
Oh, it was a grim time for the stock. You had headlines comparing them to the regional banks that failed.
I remember that.
Yeah, you had people seriously questioning whether they could even survive the high interest rate environment.
Right. But you look at the full year 2025 results that were released recently, and the narrative has completely 180 degrees flipped.
It really has. If 2024 was about defense, about, patching the holes and just keeping the ship afloat, 2025 was about going on the offense. The defensive phase is effectively over.
And the numbers tell that story.
Oh, they tell a very, very clear story of restoration.
Okay, so let's hit the headline numbers first just to ground us. Let's start with earnings per share, or EPS.
EPS jumped 50% to $4.87. That is just a massive year-over-year increase.
I want to pause on that. A 50% jump in earnings. For a company of this size, we are talking about a mature blue-chip financial incumbent. That is not something you see every day.
No.
That is the kind of growth number you expect from a volatile tech startup, not a steady financial giant.
It is so rare. and it signals that the fundamental earnings power of the firm has been restored. It tells us that the depressed earnings of 2023 and 2024 were temporary, caused by specific headwinds, and now that those headwinds are gone, the profitability is just snapping back.
And the top line, the revenues.
Total net revenues were up 22%, hitting $23.9 billion.
So the top line is growing strong and the bottom line is just exploding. But for me, the most impressive number, the one that really made me sit up, wasn't the revenue or the EPS, it was the net new assets.
This is the scale of trust, right?
Exactly. That's the perfect way to put it. You can, to some extent, engineer earnings per share. You can cut costs, you can play with tax credits, you can do buybacks, but you cannot fake net new assets.
No, you can't.
Either people are trusting you with their life savings or they aren't. It's that simple.
That is the ultimate scorecard in wealth management. It's the only one that really matters in the long run. And in 2025, Schwab brought in $519 billion in core net new assets.
$519 billion. And that was a 42% increase over the previous year.
A massive acceleration.
I was trying to wrap my head around how big that is. $519 billion. That is larger than the entire GDP of Austria.
Wow.
It is bigger than the GDP of Nigeria. Schwab essentially absorbed a medium-sized country's entire economy worth of assets in a single year.
That's a great analogy.
Yeah.
It really puts the scale into perspective. When you are operating at that level, the gravitational pull you have on the market is just immense.
And it wasn't just market appreciation.
No, and that's the even more impressive part, the organic growth rate, which reached 5.1%.
So explain what organic growth rate means in this context for the listener. Break that down.
Sure. So a company's assets can grow just because the stock market goes up. If the S&P 500 rises 10%, Schwab's assets rise. That's market movement. But organic growth measures the new money coming in the door, regardless of what the market did. It's new clients or existing clients adding more funds. So growing at 5.1% organically means that even if the market stayed totally flat, they would still be getting significantly bigger.
It shows the health of the sales engine.
The absolute health of the engine. It's firing on all cylinders.
And it's not just money, right? It's people. They opened 4.7 million new brokerage accounts.
Which is up 13%. They now have over 46 million active accounts.
Just think about that. 46 million accounts. That is a significant chunk of the American population. It just underscores how deeply embedded Schwab is in the financial fabric of the country.
It really is the bedrock for a huge portion of investors.
And what I found interesting is that the engagement is at record highs, too. Daily average trades hit 7.7 million.
Yeah.
So people aren't just parking their money and forgetting about it. They are active. They're trading. They are rebalancing. They're engaged with their finances.
Which kind of runs counter to the idea that everyone is just passively indexing.
Yeah.
The Schwab client is engaged. They are reacting to the news. They are adjusting their portfolios.
It's a very active client base.
Yeah.
Now, to really understand this incredible turnaround, we have to talk about the villain of the previous chapter.
The ghost in the machine.
We have to talk about cash sorting. This was the big, scary buzzword back in 2023 and 2024. Can you explain what cash sorting is for our listeners who might have missed that drama and why it was such a massive headache for Schwab?
Sure. It is actually a very rational behavior, but it caused a huge, huge problem for the bank. So first thing to remember is that Schwab runs a bank.
A very big bank.
A very big one. When you have uninvested cash in your brokerage account, say you sold some stock and haven't bought anything new yet, that cash just sits there. Schwab sweeps that cash into its bank.
And they pay you a little bit of interest on it.
They pay you interest. But traditionally, that rate is relatively low. Let's just say, for argument's sake, 0.5%. Schwab then takes that cash and invests it in longer-term securities, like government bonds or mortgages, that pay a higher rate, say 2.5 or 3%.
Right. And that spread, that difference, is their profit margin.
That's their profit, the classic banking model. Borrow short, lend long.
Easy enough.
Exactly. And it works beautifully when interest rates are low or stable. But in 2023, the Federal Reserve started hiking interest rates aggressively to fight inflation.
The most aggressive hiking cycle in decades.
Right. And suddenly you, as an investor, could get 5% on a money market fund or a treasury bill. Risk-free.
Right. So the client looks at their Schwab account paying 0.5% and says, wait a minute, I can get 5% over here with no risk.
Precisely. So the clients started sorting their cash. They very rationally moved it out of the low-interest sweep accounts and into these higher-yielding instruments, like money market funds.
Which is the smart thing to do for the client.
It is absolutely the smart, correct thing to do for the client. But for Schwab, that cash was leaving the bank. The fuel for their lending engine was just evaporating.
But they still held those long-term assets.
He still held those long-term assets, which had lost value because rates went up. So to maintain their liquidity, to have cash on hand, Schwab had to go out and borrow money from the Federal Home Loan Bank, the FHLB, to replace the deposits that were leaving.
And I'm guessing that borrowing wasn't cheap.
No, it was not. They were borrowing at market rates over 5%. So think about that. Their cost of funds went from practically zero to over 5%.
It completely crushed their profit margin.
It crushed it. And that is why the stock tanked. The fear in the market was that this trend would never stop, that the well of cheap cash would run dry completely and they'd be insolvent.
But looking at the 2025 data, we can officially say that the ghost has been exorcised. The cash sorting panic is over.
That is the big news. The bleeding has stopped. The balances of uninvested cash have completely leveled off. The people who are going to move their money have, for the most part, already done so.
So what did that allow them to do?
This stabilization was the key. It allowed Schwab to start paying down that high-cost debt they took on during the crisis.
So they aren't borrowing at 5% anymore just to plug the holes in the dam.
Exactly. Their balance sheet is normalizing. It's getting healthy again. And because of that, their profitability is expanding again. In fact, their bank lending balances reached an all-time high of $58 billion, up 28%.
So the bank is not just surviving, it's back in business and growing.
It's back in business in a big way.
That is such a crucial turnaround. It really explains why the earnings popped so much. I mean, if you stop bleeding money on expensive debt, that just drops straight to the bottom line.
Precisely. It's a huge tailwind, and it sets the stage for everything else we are going to talk about.
Yeah.
You can't go out and acquire companies or launch new products if your core business, your house, is on fire.
Right.
Now that the fire is out, Schwab is looking outward again.
Which brings us perfectly to the biggest strategic pivot in this entire deep dive, the acquisition of Forge Global. This was announced back in November 2025, and honestly, I think this is the most exciting, most forward-looking part of the whole story.
I completely agree. This is the most significant strategic shift Schwab has made since the TD Ameritrade acquisition, but it's a different kind of deal.
How so?
TD Ameritrade was about consolidating the public markets, getting more scale in what they already did. It was about becoming bigger. Buying Forge Global is about becoming different. It's about stepping outside of the public markets entirely.
So for those who don't know, let's just define what Forge Global is.
So Forge is a marketplace for private company securities. We
Yeah.
call them secondaries.
Okay, let's break that down. Secondaries. How is that different from, say, an IPO or a fundraising round that you read about in the news?
That's a great question. So the primary market is when a company sells its own stock to raise money. Think of a Series B or a Series C funding round, where venture capitalists give money directly to the company and get new shares in return.
Or an IPO?
Or an IPO, where the company sells its shares to the public for the first time. The money goes to the company's balance sheet.
Okay, got it.
Secondary trading is when an existing shareholder, say, an early employee who's been at the company for 5 years, or an early angel investor, wants to sell their shares to someone else before the company goes public. The company doesn't get the money. It's a transaction between two investors.
So it's creating a market where one didn't really exist before.
Exactly. Forge provides the platform, the data, and the regulatory framework to make that trade happen safely and efficiently.
Okay. And the stats here are pretty impressive. Forge has over $17 billion in transaction volume history. They trade over 625 private companies, and they have data on millions of users.
It is the established infrastructure for trading private tech unicorns. And Schwab buying them is a massive, massive signal.
Why? Why does Schwab, the king of public retail investing, want to get into the messy, opaque world of private equity? Why not just stick to selling Apple and Microsoft stock?
It comes down to one fundamental truth about the modern market. I call it the value gap.
Yeah.
Think about where the value is being created today versus, say, 20 years ago.
You're talking about companies staying private for much, much longer.
That's exactly it. Let's look at Amazon. Amazon went public back in 1997. At the time, it was valued at around $400 million. It was a tiny company compared to what it is today.
A bookstore, basically.
Basically an online bookstore. Because it went public so early, Retail investors, regular people like you and me, could buy the stock and ride that growth all the way up to a trillion-dollar valuation.
We all got to participate in the upside.
Correct. The wealth was created in the public markets. Now look at a company like SpaceX or Stripe or ByteDance. These companies are staying private for a decade, or even longer. They raise round after round of private capital. By the time they might consider an IPO, they're already valued at 50 billion, 100 billion, or even more.
So the massive growth phase, that part where you make 100 times your money, that is all happening behind closed doors.
Exactly. The venture capitalists and the institutional insiders capture that explosive growth. The retail investor gets the scraps at the IPO. By the time the public gets in, the company is already mature. The easy money is gone. The hypergrowth phase is over.
So Schwab looks at this and says, our clients are missing out on this huge part of the market.
Schwab realizes that if they want to control the entire life cycle of wealth, they can't just wait for the IPO. They need to be there from the venture-backed private stages all the way through to the public portfolio. If they don't offer this access, their clients, especially wealthy ones, are just going to go somewhere else.
They'll go to specialized private banks or boutique funds that do offer this.
Exactly. So it's a defensive move to protect their client base, but it's also a massive offensive opportunity. We are looking at private wealth capital allocated to alternatives, which includes private equity, reaching something like $13 trillion by 2032.
Wow.
That's up from just $4 trillion a few years ago in 2022.
That is a tidal wave of money moving into private assets.
It is. It's one of the biggest shifts in capital allocation in a generation. And the total valuation of VC-backed private firms is roughly $9 trillion. Schwab estimates that about 20% of that is potentially tradable.
So that's a market of almost $2 trillion.
Nearly $2 trillion, an ocean of liquidity that is currently very hard to access for most people. Schwab wants to be the bridge. They want to be the on-ramp.
So how does this actually work for the listener? I mean, can I just log into my Schwab app tomorrow and buy shares of the next SpaceX alongside my ETFs? Is that the end game?
Not quite yet. Schwab is rolling this out in phases, which is very typical for them, very methodical and careful.
Right.
The immediate rollout is for the ultra-high net worth investors, the folks with the massive accounts, the family offices.
Of course. The VIPs get first dibs.
Always.
Yeah.
They have the risk tolerance and the liquidity to navigate these kinds of investments. But the near-term plan, and this is important, includes launching a 40 Act fund.
Okay, what is a 40 Act fund? That sounds like jargon.
It refers to the Investment Company Act of 1940.
Yeah.
But basically, it's a regulatory structure that allows them to package these private assets into a fund like a mutual fund or a closed-end fund that is accessible to a broader range of investors.
Okay, so instead of me trying to pick one specific private company, which is incredibly risky,
Very risky.
I might be able to buy a Schwab private tech fund that holds a basket of them.
Exactly.
Yeah.
It solves the diversification problem right away.
Yeah.
And then, in the medium term, they are planning on expanding access to retail clients and registered investment advisors, RIAs, with over $1 million in assets.
Okay, so the accredited investor tier.
Correct. But the long-term vision, and this is explicitly stated in their strategy, is broadening retail access to all qualified investors and fully integrating the experience. They want a world where buying private shares feels as seamless and as normal as buying public stock.
That is a game changer. I mean, that completely blurs the line between public and private.
It does. It fundamentally changes the structure of the market. And strategically, for Schwab, it differentiates them in a massive way. If you are a high net worth client and Schwab offers you access to pre-IPO unicorns and Fidelity or E-Trade doesn't, where are you going to put your money?
You're going to Schwab. It's a moat. It's a reason to stay, a reason to bring more assets over.
It is a massive moat, and it leverages their greatest strength, which is scale. They have the clients, $12 trillion of assets who are hungry for this product. Forge has the inventory and the piping. It's a classic, beautiful synergy play.
It's fascinating. It really positions them as that comprehensive wealth platform, not just a place to buy and sell stocks.
Completely.
But speaking of platforms and new asset classes, we have to talk about the other big shift happening, crypto.
Yes. The long, complicated love-hate relationship the financial industry has with crypto.
It seems like Schwab has been on the hate, or at least the ignore side for a very long time. They're like the parent who just refused to buy the video game console for the kids.
That's a great way to put it.
But now, in the first half of 2026, they are rolling out spot crypto trading.
They are. And the timing here is it's very Schwab.
Meaningly.
Meaning deliberate. Think about the competitors. You have Robinhood, Coinbase, even Fidelity to some extent. They were in early. They rode the wild volatility of 2021. They dealt with the crypto winter of 2022. They took the arrows in the back.
Schwab just sat on the sidelines and watched.
They did. They watched. They let the regulatory dust settle. They waited for the spot Bitcoin ETFs to launch and sort of normalize the asset class for institutions. And now, in 2026, when crypto feels more like a standard financial asset and less like magic internet money, now they are entering.
So why now? Is it just FOMO? Fear of missing out?
I don't think it's fear of missing out. It's a response to client demand. But not just any clients. They're wealthy, they're older, they're more conservative clients who perhaps dabbled in crypto elsewhere on Coinbase or another exchange are now saying, look, I want to see my Bitcoin right next to my municipal bonds in one single dashboard.
They want to bring the assets home.
Exactly. Schwab isn't trying to capture the 22-year-old day trader who's flipping Dogecoin on Robinhood. That's not their game. They are trying to consolidate the assets of their existing client base. They expect those long-standing clients to transfer their crypto holdings from other platforms into Schwab.
So it's a retention play as much as it is a growth play.
I think that's exactly right.
It fits their brand, doesn't it? They aren't trying to be the cool kid in the room. They're trying to be the reliable parent.
That is the perfect transition to their stance on sports betting, because this is where the identity of the company really comes into sharp focus.
I found this part of the research fascinating. The CEO, Rick Wurster, has taken this very firm, almost moral stance against sports betting.
He has. And you have to contrast this with what's happening in the market. You look at Robinhood. You look at some of the newer fintech apps. They are increasingly blurring the lines between investing and gambling.
Oh, absolutely.
They're adding features that look and feel like sports books. They are gamifying everything with confetti and push notifications and leaderboards.
And Schwab is just saying no, a hard no.
An explicit no. Wurster's philosophy is that sports betting is contradictory to their mission of wealth creation. He cites the data. Less than 5% of sports gamblers win in the long run.
Right. The house always wins.
The house always wins. So if your mission as a company is to help people build long-term wealth, why would you offer a product that statistically destroys it for 95% of users?
It's a strong stance. It's almost countercultural in this age of instant gratification and, dopamine hits from your phone.
It is absolute brand discipline. They are signaling to a specific type of customer. We are serious about your money. They aren't trying to monetize your addiction. They're trying to compound your capital. It distinguishes them from what you might call the casino apps.
But there's a nuance here, right? Because they aren't against all prediction markets.
Right. And this is a really interesting distinction they're making. They are open to economic prediction markets. So things like betting on future inflation rates or Fed fund rate moves or GDP growth.
Which arguably is what the stock market is anyway. It's a bet on the future of the economy.
Exactly. Those are financial instruments. They can be used as hedging tools.
Yeah.
If a corporate client wants to hedge against inflation, that's a legitimate financial strategy. Betting on the Super Bowl is entertainment.
It's a different category.
It's a different category. And Schwab is drawing the line at entertainment. They are in the business of finance, not gambling.
I like that. It's a very clear line in the sand. It helps define who they are and who they are not.
For sure.
Now, let's talk about the other buzzword that every company in 2026 has to mention. AI, artificial intelligence. We're told Schwab has over 220 AI use cases in production. Is this just, marketing fluff, or is it real?
In Schwab's case, it seems to be very real and very operational. They aren't just slapping a chatbot on the homepage and calling it a day. They're using AI to drive efficiency deep in the stack.
Okay, so give me some examples of how this actually helps the listener, the end client.
Well, they have the Schwab Knowledge Assistant. This helps their advisors and their internal staff access information instantly. So imagine you call customer service with a really complex question about, a corporate spin-off tax implication.
Right. Usually that means you're getting put on hold for 10 minutes while they frantically look it up in some manual.
Exactly. But with the Knowledge Assistant, the advisor just asks the AI and gets the answer instantly while you are still on the line. It speeds up the service. It improves accuracy. Then they have the Schwab Research Assistant for investment analysis.
So it's about making their own people more effective.
More effective, more efficient. It's entirely about scale and cost. Look at this one metric. Their adjusted cost per account is around $11.
$11? That seems incredibly low.
It is industry leading. Compare that to the wirehouses, the Morgan Stanleys or the Bank of Americas of the world. Their cost per account is significantly higher, sometimes double or even triple that number.
So how does AI lead to that?
By using AI to automate the routine service tasks, the simple questions, the data retrieval, Schwab can serve those 46 million accounts without having to hire a proportional army of support staff.
That keeps their fees low, which attracts more clients, which gives them more scale. It's a flywheel.
It is the ultimate flywheel. That efficiency is what allows them to maintain those profit margins even when they are investing in big acquisitions like Forge. It is the engine room of the company that nobody sees.
Okay, let's zoom out a bit. We've talked about the company, the acquisition, the tech, but Schwab doesn't exist in a vacuum. They are operating in the global economy, and the economic outlook for 2026 is being described as stagflation light.
Stagflation light. It sounds like a bad beer, doesn't it?
It really does. Tastes terrible, less filling.
It's not the most optimistic economic term, that's for sure. Essentially, stagflation is high inflation and stagnant growth, the absolute nightmare of the 1970s. The light version we are seeing in 2026 is a much milder variant.
So what does that mean in practice?
We are looking at sticky inflation. It's hovering above the Fed's 2% target, likely sitting in that 2.7 to 3% range. It just won't go down to that magic 2% number.
But growth isn't stagnant like in the 70s.
No, growth is moderate. The U.S. is forecasted to grow at about 2.2%. So we aren't in a recession, but we aren't exactly in a boom either. It's just, eh.
So sticky prices and moderate growth. What does the Federal Reserve do in that kind of scenario?
They hold. They wait. The Fed has paused its rate cuts. We saw 3 reductions previously, but now they have hit the brakes. The consensus is that rates are expected to settle around 3 to 3.25%.
Which is higher for longer than people were expecting back in 2024.
Much higher for much longer. But here is the fascinating part. For Schwab, this environment is actually kind of okay. In fact, it might be the perfect environment for them.
Really? How can that be? I thought high rates were the whole problem that started this mess.
Rapidly rising rates were the problem. That's the key distinction. Rising rates devalued Schwab's bond portfolio and caused that cash sorting panic we talked about. But stable higher rates, that could be very good for them.
Explain that. That seems counterintuitive.
It all comes back to net interest margin, or the NIM. If rates are stable at 3%, Schwab can earn a decent return on the cash it holds. As long as they don't have to pay out too much to depositors, and remember, cash sorting has stopped, they make a very healthy spread.
So they're earning more on their cash.
Exactly. And if the yield curve steepens, meaning long-term rates like the 10-year Treasury go up higher than short-term rates, banks generally make even more money.
Because they borrow short and lend long. The bigger the gap, the more profit.
Exactly. A steep yield curve is a bank's best friend, and the 10-year Treasury is expected to be around 4% or even higher. So if they are paying depositors, say, 1% and earning 4% on the long end, that is a very healthy profit engine.
So stagflation light, while annoying for consumers at the grocery store, provides a very stable, profitable operating environment for a financial giant like Schwab.
It's kind of their sweet spot, weirdly enough.
What about the equity markets? If inflation is sticky and rates are higher, is the stock market going to suffer?
The outlook suggests that equities still face a narrowing edge over risk-free investments. We talk about the equity risk premium. Basically, if I can get 4 or 5% risk-free in a bond, why should I risk my money in the stock market for a potential 7% return?
The reward for taking the risk isn't as big.
Exactly. The gap isn't huge, so investors might be more cautious. They might demand more value.
So what's the bull case for stocks then?
The counter-argument is productivity. The massive investment in AI, not just by Schwab, but by the whole economy, is expected to drive real productivity gains. That supports economic expansion, even with higher rates. So the U.S. economy growing at 2.2% is actually quite strong compared to the rest of the world.
Right, let's look at that global context for a second.
Compare the U.S. to the U.K., which is looking at maybe 0.8% growth, or Canada, which is around 1.4% and dealing with a lot of trade tensions. Schwab is heavily U.S.-centric.
So they're insulated.
They are largely insulated from the sluggishness in Europe or Canada. They are betting on the American consumer and the American investor, who, despite everything, remain remarkably resilient.
It's the old cleanest dirty shirt theory. The U.S. might have its issues, but it still looks better than most of the alternatives.
Exactly. And Schwab is the perfect proxy for that U.S. resilience.
So we have a recovering company, A massive new strategic acquisition, a powerful tech advantage, and a supportive, if not, exciting macro environment. What does management do with all that cash they are generating?
I give it back to the shareholders. And this brings us to capital return.
The dividend hike.
This was a huge signal to the market. Schwab raised its quarterly dividend by 19% to 32 cents per share, payable in March of 2026.
A 19% raise is significant. That is a statement of confidence. You don't do that if you are worried about your balance sheet.
You absolutely do not. Boards of directors are conservative by nature. They hate cutting dividends more than anything, so they only raise them aggressively when they are supremely confident that the earnings are sustainable. This is the all-clear signal.
So this tells the market.
It tells the market the restoration phase is done. We are generating excess capital. We are back.
And they also mentioned stock buybacks are on the table.
Yes. They plan to return capital via buybacks in 2026. This depends on their capital ratios and growth needs, of course. But the intent is there. They want to shrink the share count, which boosts EPS even further. It's another lever to pull.
So let's talk valuation. With all this good news, is the stock cheap? Has the market already priced this all in?
Well, analysts seem to think there's still room to run. We see market outperform ratings being reiterated. Some analyses we've seen suggest a fair value around $137 per share.
And the stock is trading where now?
Around $102 in early 2026. So that implies some pretty significant upside. The market is still pricing in some skepticism, or perhaps just a wait-and-see approach on the Forge integration and how that plays out.
Which creates an opportunity if you believe the story and their ability to execute.
Exactly. If you believe they can pull off this private market integration, then today's price looks attractive.
What are the risks then? What could derail this train? Because it's never a straight line up.
No, never. There are always risks. The biggest one is still interest rates, but moving too fast in either direction. If the Fed has to cut rates aggressively, say because of a sudden unexpected recession, that compresses Schwab's margins again.
Right. The spread gets smaller and that profit engine slows down.
Exactly. The other big risk is regulation. They are stepping into crypto and private markets. Both of those are regulatory minefields. If the SEC decides to crack down on secondary trading or change the rules on crypto custody, that could really hurt the growth story.
And cybersecurity has to be on the list.
Always. It's maybe the biggest risk of all. When you hold $12 trillion and you rely on AI for everything, you are a massive, massive target. A major breach would be catastrophic for trust. And at the end of the day, trust is their only real currency.
So let's bring this all together in our synthesis. We've looked at the numbers, the strategy, the tech, the environment. How do we sum up the state of Charles Schwab in 2026?
I think you have to see Schwab as a $12 trillion juggernaut that has successfully reinvented itself. They face a near-existential crisis with the cash sorting issue in 2023 and 2024, and they didn't just survive it, they fixed it. They solved the root problem.
And then they went on offense.
They modernized their tech stack, and now, instead of playing defense, they are aggressively targeting the two biggest growth areas in finance, the private market and crypto.
And they are doing it all with a very specific philosophy, which you hear them repeat over and over. Through clients' eyes.
That is the red thread that ties it all together. Why are they doing crypto? Because clients want it. Why are they avoiding sports betting? Because it hurts clients in the long run. Why are they buying Forge? Because clients need access to pre-IPO growth to build wealth. Every single move can be traced back to that core belief.
So for the listener tuning in, whether they are an investor in Schwab stock, a client of the platform, or just an observer of the financial industry, what is the so what here? What's the key takeaway?
For the investor, Schwab is positioning itself as the one-stop shop for the entire life cycle of wealth, public, private, lending, and advice. They want to be the operating system for your financial life. If they succeed, they will capture a massive, and I mean massive, share of wallet from their competitors.
And for the observer, for someone just watching the industry.
It is a fascinating case study in how a legacy incumbent can successfully pivot. We often think of the startups as the innovators, the disruptors. But here is Schwab, a company founded in the 70s, swallowing up the innovation forge and deploying it at a scale the startups can only dream of.
It proves that scale, when combined with agility, is almost unbeatable.
It's the empire striking back.
In the best possible way.
For them, at least.
Before we sign off, I want to leave the listeners with a final provocative thought. We talked a lot about Forge Global and this blurring of the lines between public and private equity.
This is where it gets really interesting for the future.
If Schwab succeeds and other big brokers follow them, and retail investors can easily buy shares in private unicorns like SpaceX or the next great AI giant through their standard brokerage app, are we seeing the end of the traditional IPO?
That is the multi-trillion-dollar question, isn't it? Traditionally, the IPO was the exit event. It was the moment the company cashed out its early investors and finally let the public in.
A big party.
The big party. But if the public is already in, if millions of Schwab users essentially own a piece of the company while it's still private, does going public lose its luster? Does the IPO just become irrelevant? Just another liquidity event, but not the liquidity event?
Or does the stock market just become everything? Private, public, it's all just tickers on a screen with different levels of risk and disclosure.
It's a convergence. And Schwab is building the bridge for that convergence. If they pull it off, the distinction between Wall Street and Silicon Valley venture capital might disappear completely for the average investor.
Something to mull over as you check your portfolio today.
Indeed. A big change on the horizon.
That wraps up this deep dive into Charles Schwab, a giant that is definitely not sleeping. Thank you for listening to the Pro Ticker Deep Dive. We will see you next time.
Stay curious.